Finding ways to build wealth is the goal of most investors. Multimillionaire John Maynard Keynes made his mark on global economics with savvy investments and even gave financial advice to world leaders such as former U.S. President Franklin Delano Roosevelt and former British Prime Minister Winston Churchill. In his new book, Keynes' Way to Wealth, author John Wasik explores Keynes' tips for finding success in uncertain economic times. And John joins us now from Chicago. Thanks very much for joining us. I guess it couldn't be more timely considering everything that Keynes succeeded at. If you think about, he went through deflation, inflation, war, after war, unemployment. Seems like we could learn a great deal from his investment style, not just here in the U.S., but internationally as well, wouldn't you say?
Oh, definitely. Keynes had a very interesting style. He started out speculating in commodities and currencies, and then went to stocks, and he adopted a very value style, not unlike Warren Buffett. So he learned as he went along through some of the worst markets in history.
Specifically, let's talk about some of the things that you talk about. Diversified portfolios, that makes total sense. But working contrary to the popularity in markets, why does Keynes think that works?
Well, he called them opposed risks, and this means that you try to find stocks or different kinds of investments that are not going in the same direction at the same time. So say he would have railroads, he would have industrial companies, commodity-based companies, things that wouldn't necessarily move in lockstep.
What do you think investors, not just here in the U.S., but in Asia, in Europe, what nugget do you think that people can really take away from this when you look back on someone who was born 130 years ago but was wildly successful at what he did, as you mentioned, through some of the worst of times?
Well, the real timeless thing that Keynes learned is that you pick companies with value. You call them enterprise value, companies that are going to consistently produce earnings and dividends, and you hold on to them for the long term. You forget about the short-term noise in the market, and if they have value and they're producing earnings, you just stay the course.
You look at investing as a marathon, not a sprint. Kind of expand on that. How does someone get through something like that, especially when we saw the markets collapse just a couple of years ago? I've seen my retirement account go up and down like a yo-yo. How do you pretend that isn't going on?
Well, you try to look at value at the time. If there are good companies out there, what Keynes did is he bought them at good prices. And if the market goes down, you buy more of it. So you're doing this counterintuitively. You want to get companies at good values and you want to hold on to them. And if they keep earning money and paying dividends, you just stay with them.
You know, it all makes sense. I mean, everybody wants to buy valued companies. Everybody wants to stick with them, knowing that these blue chip companies are going to continue. But what's the key in that? What kind of insight in terms of studying his investment methods, considering he was someone that Warren Buffett, George Soros looked up to? What can we take away from this? How do you do that? I mean, what you're saying is the simple part. What kind of insight, after studying him and coming up with this book, can you provide us?
Well, Keynes said that there were animal spirits, and they were really moving the market in irrational ways. And if you can ignore the short-term distractions of what's going on and focus on the long term for yourself, find out what you need to be doing at any time, and really just look at your portfolio once a year. If you're off course, you can rebalance, but really look to your own goals and stick to them.
I think that one thing in the forward, I believe it says, look, if you're going to invest, if you're going to want to know something about the economy, you have to know economics. What can someone who isn't going to try and get an MBA, what can we pick up on in terms of what Keynes would pass on?
Well, I think economics is very difficult to grasp for most people, but if you know how much you'll need to retire on, if you know how much risk you can take, those are the two most important things that you can internalize and pay attention to. And all the other things are just going to get you there if you're patient and if you tune out a lot of the noise from the market.
Great. The book is called Keynes' Way to Wealth. John Wasik, the author. Your 14th book, correct?
Yes.
Okay, great. It could be a good stocking stuffer, right?
I hope so.
Okay. Thanks very much for joining us, and let's hope from your mouth to everybody else's ear out there.